Section of the stock markets and of developments in the Zimbabwean economy. Thank you for joining us as we broadcast live from our Hampton studios in Harare. I'm Ibn Mabunda. Let's get on to business. Our news tonight: gold deliveries from Fidelity Printers has just been released for the month of March, and according to the stats there that have just been released, gold came in at 2.6 tons, which was 22% up from the deliveries recorded during the month of February. For the quarter, volumes are down 11% against the same period recorded in the previous year. Well, let's just get into the stats so that you get an appreciation of what is actually played during the month of March. According to the stats, primary producers, which are the big corporates, that's your Falcon Gold, your Zim, raking in 32%, then the small scale miners raking in 68% in that particular order. Then moving on to where it is that we're coming from in terms of the stats from a historical perspective, moving right up to where it is that we are actually sailing at the moment, going once, going twice. Right now, 2002 we recorded a tonnage of 15.5 tons, 2003 12.6. Now 2006 there we recorded 11.4 tons, 2007 7.7 tons. Now in 2008 we record a decline. Now there seems to be what is a strong correlation between economic fundamentals vis-a-vis the gold deliveries that we actually have recorded in the country. So things worsen in terms of our economy, in terms of the inflation, 2007, 2008, 2009, hence the decline. When things then stabilize with dollarization, we see what is a steady growth in terms of our national output in terms of gold. Now we have come right up from 2008 at 3.6, moving right up to 33.2 tons in the year 2018. Actually in 2018 government had set a target of 30 tons, which was then revised upward to 34 tons, and we fell at 33.2 tons. Now what we have playing out, government has set a target of 40 tons for the year 2019, and what we have playing out is what seems to be a decline in terms of the performance of the gold deliveries up to this point. And during the first quarter, record volumes that are actually 11% below the prior year figures recorded during the comparative period. So question then remains, will we be able to actually hit the figures in question, which is 40 tons for the year? From where I'm standing, it seems as though we are not actually in line to hit that particular figure. Now moving on to another stats that have just been released from Zim stats, you'd find that inflation for the month of March has come to 66.8%. That's according to Zim stats. Well, of course, month on month inflation grew 4.4%. Now just to get a historical appreciation of what is actually transpired, to take you back to last year in October the 1st, where we had a monetary policy statement issued alongside a fiscal policy statement, and according to what was said there, introduction of the 2% tax, as well as of course the separation of the Nostro FCA from the RTGS balances. Now that of course brought with it seismic shifts across the economy, and at that particular point we see inflation for October 20.9%, November 31%, December 42.1%, January 56.9%, February 59.4%, and March we are coming in at 66.8%. Finance Minister Professor Mthuli Ncube is insistent that inflation should narrow down to a single digit by the end of the year. IMF says we will record 40%. It remains to be seen who will be the better prophet at the end of the day. Moving on to other news, ZSE listed FBC Holding held an analyst briefing in the capital with financials for the year 2018 being released. FBC Holdings, of course, is a diversified corporation that is invested in banking, insurance, financial services, securities, as well as running a building society. Revenue scaling 39% to $146 million, while FBC Bank contributing 56%, the building society 13%, FBC Insurance 13%, Microplan Financial Services 7%, among other business units that the corporation actually has. Profit after tax mounting 91% to $44 million. In terms of the outlook, the group will be launching a venture capital unit aimed at small to medium businesses with a forex orientation. The group set up a digitalization team which is going to monitor as well as come up with innovative products within the digi space. I had a close up with the chief executive, Mr. John Mushayabano. Let's have a look. Let's talk about the $90 million loan facility rather, that has been expended to you through the AfriZim Bank. Would you want to shed more light in terms of the utilization?
And what we then did with that money was we deployed it to the productive foreign exchange generating sector, but in a fully ring-fenced and fully secured arrangement, which makes sure that the export proceeds are put in an escrow account before they reach the exporter's account. In that way, we are able to get our interest repayments when they fall due, and we are also able to get our capital repayments when they fall due.
I realize. Now let's talk about the new venture capital engagement that the group has actually set up. What sectors are you looking to invest in? Do you have any specific categories that perhaps you're looking to actually play on?
Yeah, we are mostly looking at SMEs who have export-oriented projects. What we realized in the past was that people thought that when a person has started a business and they need capital, that capital can only be provided by a bank in the form of a loan. But that arrangement does not always suit most businesses, because some businesses have got a long gestation period. From the time you make available the capital to the time you build the infrastructure and you put the machinery in place, it could be 3 years. And in 3 years, if a loan has not been serviced, it becomes non-performing. So we decided to start a venture capital company where we assist these export-oriented SMEs with capital in the form of equity that we make available to them to kickstart the business. And when the business is up and running, we run with them for a few years, and then we divest, either through listing the venture on the stock exchange or through selling our shares to the promoters of the business. That way we think we will have a situation where startup SMEs do not fail. Because if you start an SME with debt capital, you are bound to fail. Because that loan becomes due when there is no income from the business to pay that loan. Yeah.
And lastly, let's talk about the prospects in Mauritius, FBC Mauritius. What of course, you did mention the fact that there are licensing issues to do with that. Do you have perhaps a time frame that we could perhaps expect the birth of this new baby in Mauritius?
Well, all things being equal, I'm expecting that by the time we start the second half of the year, we should be operational.
Let's talk about the $90 million loan facility. Released financial results for the year 2018, of course, at an analyst briefing. The bank is formerly Barclays Bank and is now under a new owner after parent Barclays PLC actually sold its African unit in 2017. The bank is now controlled by the Mauritius-based banking group, which is FMB Capital Holdings. Resultantly, it has rebranded from Barclays Bank into the First Capital Bank. Revenue scaling 14% to $82 million. Profit after tax grew 23% to $24 million from $20 million recorded in 2018. Let's just get into the stats to get an appreciation of what actually transpired in that particular sector. Well, this is the performance of the corporation moving right from 2014 to 2018 in that particular order. Well, according to the stats, fee and commission income is shrinking by 15% year on year to contribute 35% of total income, while interest income contributing 51% in the financial year of 2018. Well, this is the growth pattern in terms of the loans as well as treasury bills. Well, this is 2014 recording loans of $122 million, 2015 141, January of 2016 140, 112, 195, and then we have treasury bills there recorded at $283 million for the 2018 financial year. Interesting developments there in that particular order. Then moving on to other business news, a Mauritius Zimbabwe Business Exchange Expo was held in the capital with a 9-member Mauritian delegation engaging local businesses. The delegation is under the leadership of the Economic Development Board of Mauritius and is aimed at enhancing bilateral trade between Zimbabwe and Mauritius. The delegation came in courtesy of Isaja, which is a B2B platform linking buyers and suppliers in the region. The Mauritian delegation is focused on textiles, liquor, clothing, chemicals, as well as IT services. Head of delegation Mr. Utimu issued a statement expressing interest to engage in businesses with Zimbabwe. Let's have a look.
Organization, the Economic Development Board, and we operate under the aegis of the Prime Minister's office. As we said, our mandate is now quite large. We promote trade, investment, and we act as a policy advocate for the government. Now, the mission today to Zimbabwe is very important for us. We believe strongly in regional integration. We all know that intra-Africa trade is very low. And being members of COMESA SADC, it's important that we promote trade within the region. I take an example. Zimbabwe is about 200 times the size of Mauritius. You grow a lot of maize, and Mauritian companies are importing corn from Argentina. So we want to improve trade within the region, so we have to look within the region. Why go to Argentina? Think about the cost, think about the time. So these are the types of opportunities that we need to take and work together. Also, Mauritius has experience in EPZ, in developing special economic zones. We are doing that with Senegal, we are doing that with Côte d'Ivoire, Ghana, Madagascar. And last week, the President of Kenya, His Excellency Uhuru Kenyatta, was in Mauritius, and he even sought the assistance of Mauritius to develop a special economic zone in Kenya. So similarly, I think you got lots of resources in Zimbabwe, and we can work together for the benefit of Zimbabwe and Mauritian enterprises. They can come and set up here through joint ventures and also encourage trade with Mauritius. So this mission to Zimbabwe is very important, particularly taking into consideration the change in government. Now, through your budget, through the reforms that the government is bringing forward, it's particularly interesting for us to come and set up here, because I still remember previously we had Mauritian companies in Zimbabwe and we were trading a lot with Zimbabwe. So we have to renew the interest for Mauritian companies and Zimbabwean companies to collaborate for the BRELA organization.
Take a short break, and when we come back, we'll have a review of the news that we just reported. Please stay tuned. Welcome back, viewers. I'm now joined in studio by our very own investments analyst. To my right is Tinashe Kadu, and then we have the chief analyst, Respect Gwenza. Gentlemen, good evening and welcome to the show.
My pleasure, Eben. My pleasure, Eben. Good evening, viewers.
Fantastic. Let's cut to the chase. Let's just start by having a look at First Capital Bank. Well, we have footage from the chief executive officer who's talking about the performance of the bank. Let's just have a look and then we'll take it from there.
Like to believe, and you can test us as we share the numbers, but we would like to believe that for 2018 we remain firmly on course in terms of what we set out to do and the plans that we had. So if you look at the loans and advances, they went up 74%. Our interest earning assets went up 124%, and we'll be seeing what that split shows. We also had, if you look at the commercial loans alone, commercial segment was up 123%, and you will also see interbank placements coming through there for the deployment of our surplus. We also had to ensure that we sustained a good run rate in terms of customer acquisitions. And within across the segments, we were sustaining an average of about 1,200 new customer acquisitions per month. You naturally understand that most of that would be in retail, but we also had new acquisitions in business banking and cooperative investment banking. Some of them are regional, and you will also see us sustaining the correspondent banking relationships for major currencies. We established new lines of credits, additional to those that we would have had within the Barclays Bank scenario system setup that we had. We relaunched the investment banking. We also participated in a number of initiatives which are of national significance during the year. We grew the client base, increased our penetration within some segments where we were probably virtually absent, but which are very relevant to the economy and to the performance of any significant banking player. We reintroduced the commercial asset finance offering, strengthened our trade finance desk. We also responded to the corporates where they required or desire to have some kind of products. We enhanced our diaspora proposition. During the year, we did campaigns in the US, we did campaigns in the UK, and we are extending that to other territories with the encouraging response, I must say, in terms of the uptake of our offering. Our e-channels, I must also say, were probably the hardest hit area during this year. And in some of the lines, when you look at the revenue lines, and when you look at the transactional fees income lines, I think this context of us having had to hold back on e-channels will actually show. And it was because we were changing the core banking, we were changing the switch, we couldn't expand the e-channel offering or enhance it whilst we were doing it. So we would be the first ones to acknowledge that we lost a bit of money on the table, we left a bit of money on the table in the transactional.
Well, there you have it. Gentlemen, First Capital Bank releasing financial results, and according to the results, revenue scaling 14% and profit after tax 23% to $24 million. What is the relevance of this in light of what we've seen play out in the economy, interest rates, as well as, of course, other developments that have taken place? We want to shed more light. I'll start with you, Tinashe. Let's dig into this.
Thank you, Iban. This is actually an impressive performance by First Capital Bank, considering that its first year or its first full year results under a new shareholder under the name First Capital Bank. If we go into the results, you see that net interest income was the major driver of revenue, which is actually a good thing, because net interest income, that's your income from your lending activity. But you also find that the bank also took a decision that it wanted to boost its short-term earnings, and it invested much in treasury bills. So there was actually a driver also in terms of treasury bills holdings. You may see from these results that your TB's holdings, actually they grew by to 283 million, which you see that's a decision by the management of that bank to boost their short-term earnings. But the question is it a sustainable solution, considering the developments in the economy? Some, they say the way the government is running its fiscus, going the treasury route, is risky for a bank. It's actually something that we actually have to decide to dissect during our discussion.
Okay, but let's talk about the responsibility on the part of the bank, of what you respect. How responsible has the bank been with regards to the treasury bills that you've seen scaling in that regard?
From my end, I think I would love to start from where this bank is coming from. So we're seeing Barclays PLC ceding its shareholding, basically divesting from its African operations, and Zim got snapped by a Malawian-based bank, which is registered in Mauritius. But what's quite clear is that there's a shift in strategy when this bank comes on board. What the immediate thing was to increase its risk appetite. If you look at Barclays from the previous years, from all the years going back during the Barclays Bank PLC's time as the co-owners, we found that non-interest income was the key driver of income. Looking at the basic numbers from 2014, you can see the ratio there in terms of non-banking income, interest income and non-interest income. And then when you get to 2017, getting into 2018, there's actually we're beginning to realize the shift in terms of how income is arranged within the bank. And one of the specific instruments they've used lately to drive their interest income has been the treasury bills, which, like Tinashe said, it's subject to debate whether it's a good strategy or not. But the macro fundamentals have shifted. Definitely there's been need to preserve capital, but at the same time you also need to sweat the same capital, because inflation is rising and whatnot. So you have, management is on the receiving end. They have to make a move, and obviously the bank decided to take the route of investing in short-term treasury bills. But I want to feel that the appetite it grew at a disproportionate rate given other macro developments. But at the same time, would you leave the money open, or unhedged, or do they have alternative investments which they could have possibly placed their money against? And I think the areas are quite less. But as they get into 2019 and 2020, there's need to possibly diversify, shift focus, and try to rearrange the bank and see other areas. Some banks are playing in property development, and some banks are playing in other different avenues, be it insurance and so forth. And these are areas where the bank might want now to start to explore and try to boost their non-interest income. But again, if you have to look at the non-interest income, the bank has faced challenges basically with the migration of systems, and this has rendered most of their e-platforms inaccessible, and most of the times there's been a serious downtime, whereas other banks have been more aggressive in terms of investing in their e-platforms and basic platforms that deal with non-interest income. And so this has been one of the major dampeners of performance in the period. That's why they realized that decline. If you realize most of the transactions, Barclays, FCB, lately there haven't been most of the time their online platform has been down. It's because FCB has been migrating its system from the previously reconciling the system that was being used by Barclays to the current one, which is being used by FCB, of which the Barclays one has been derelict. It wasn't still being updated by the UK guys. So this has been one of the major drawback within their system, and it remains to be seen as well now if they can catch up to what the market is demanding and where other players have come up to.
Okay, back to you, Tinashe. What then can we expect in terms of strategy from the corporation moving forward?
If you look at, maybe to add on what Respector was saying pertaining fees and commission income and other non-funded income lines, actually Barclays has been investing in its infrastructure, migrating from that of Barclays. So what First Capital Bank has done, it has actually introduced, or is actually introducing 56 new core banking systems that will be supporting its non-funded income line. This is actually a good line, and there is actually a market share which it will gain from that income line. So you may see, if you look at the past experiences, that non-funded income line was contributing as much as more than 50% to total income. So if it happened to regain its market share, you might see the 27.5 million being expanded to levels more above that 40 million, the net interest income line. So it's actually exciting for First Capital Bank, which was also aggressive in terms of customer acquisition. With more than, I think the number, if I'm not mistaken, they now have a good sufficient or a good number in terms of the customer base, which gives them a muscle in terms of transactional business activity. So I see their outlook very positive. And also, if you look at the structure of their balance sheet, closer to 50% of their balance sheet is in US dollar or is in foreign currency, which is actually a very good asset for them, and they are actually better positioned for a greater takeoff.
Yeah, but I think if I may to interject, I think when you're looking at FCB going forward, it's also about the quality of their book, the quality of their clients. If you're saying you are aggressing in terms of new clients, this has been a very liberal approach they've taken lately. Previously, you couldn't just open a bank account with Barclays that easily. So they've relaxed their requirements, and that also actually increases the risk as well. That is, if a new client is coming into the space where they end up being legit for borrowing. So it definitely, so I want to believe that the quality of the acquired new clients might not be the same as prior years. In prior years, you would find Barclays attracted all the big players, be it in mining and so forth, and obviously some of these would definitely be moving. So you might be gaining more in terms of numbers, in terms of just general numbers, but in terms of the quality of the acquired clients, I think there's gonna be a problem. And also, I believe these constant outages in the current year and the year past, obviously it has moved some who might be impatient, and they might have possibly migrated to other players who have been more serious and aggressive in that regard. But like you said, they have got a plan. They are releasing more to their infrastructure, basically the core banking system, and they're now playing in the retail space, more on the retail space. But the big guys, I believe they're bound to lose some of those.
I realize.
Maybe I wanted to add on to what Respect has been saying. You see, when you are in a transformation, sometimes it depends with your strategy. And one of the good strategies that FCB implemented was they actually know that the customer is their asset. So they had to acquire a sufficient number of customers first, and then they migrate to the new system. These new systems, the outages, but the FCB, it actually communicated to its clients, and has been using personal customer relationship management strategy as a way to increase the portfolio or the wallet that the customer would transact through First Capital Bank. So now, if it has invested in the new systems, and the new systems, I think they said they'll be coming on board, all those 56 core banking platforms, they'll be coming on board in the second quarter. So I think this is actually a good experience, especially for its customers and even for potential customers as well. But as a bank in transformation, To me, I think it's an impressive performance. Most of the banks that went through this transformational phase, some they actually failed even to break even,
Okay.
and some even they went out of business. So I see it actually as a positive and a very good performance from First Capital Bank.
Well, thank you, Tinashe. I know you gentlemen cannot wait to talk about inflation and gold deliveries. We're just going to take a short break. When we come back, we'll dive right into the inflation figures as well as the linkage that exists between the fundamentals as well as the gold deliveries that we record. Please stay glued to your screen. As well as Tinashe Kadu. Now, gentlemen, inflation figures for the month of March are out, and we have recorded an inflation figure of 66.8% with a month-on-month growth of 4.4%. Well, let's get into that. What is the relevance of that where Zimbabwe is concerned? I'll start with you, Respect.
Obviously, this is not something that's surprising to us. We've been looking at these numbers for quite some time, and we definitely have our projections in there, and our projections are really pointing in the direction of further growth. But if I'm to break this down, I think for the benefit of our viewers, we're coming from a background of a shift in the macro environment where we adopted the new currency, and we are also coming from a point where there's been increased taxation after the 2% intermediate money transfer tax, and a whole lot of other austerity measures. And much of the measures that were introduced late in 2018 have resulted in not just a decline in aggregate demand, but they've tended to also push costs. Because whereas you were transacting, on any other platform, your cost of transacting has now increased, and that cost has been passed on to the consumer. So we have seen a rapid price increases since then, and also people and general rational people have been positioning themselves given the dynamics around currencies. Since October of last year, the currency has really plummeted against the US dollar. The alternative then, which was your local alternative, the bond note and the RTGS. So we are now in a situation where prices have been increasing following the exchange rate, mainly informed by the exchange rate. But as we look forward, there is likely to be further pressure coming from the El Nino-induced drought, which will definitely result in low supply of agric produce, and that definitely is a key driver. If you look at food, basic food, it has got a weight of about 31% on the CPI, the present CPI. Definitely, there's gonna be a huge impact coming from the El Nino, but also the producer prices have already been increased by government, and that's gonna have a very huge effect in terms of driving prices going forward. I think those are some of the key fundamental considerations when one is to look at where inflation is at and where inflation is likely to go.
I realize. What would be your assessment with regards to what we've seen playing out in terms of the trend, and perhaps your estimation of what we can expect going forward?
Eben, what I can say maybe before I start, when we moved away from the dollar to RTGS, there are so many factors that came into play that are actually contributing to higher levels of inflation. In terms of making pricing decisions, what we are seeing is most players, they are still maybe first setting their prices in US dollar, then they will convert them to RTGS dollars. So in essence, in terms of our thinking or our behavior, we are still, in essence, we are still dollarized. So the rapid rise in inflation, it partly entails loss in confidence in terms of policy direction, sure, and also an element of what I may call predatory pricing. We are in an economy, we have businesses that are accustomed to higher margins. So in terms of protecting those higher margins in an environment of depressed demand, you can only either grow your revenue either by raising prices or by pushing volumes. Sure. But volumes right now, they are depressed because of the effect of austerity, because you'll be your disposable income will be very low, so you won't have that that purchasing power or that buying capacity, so your volumes will be down. So for businesses, they are just left with one option, to raise prices. So the issue that's being told in the economy, that there are some cartels or certain individuals that are controlling prices, yes, it might be true, because our markets are weak and they can be easily manipulated. So this is what we are seeing that's coming into play in this economy. And also as well, prices, we can use them as a proxy measure of confidence. When a policy is saying something and actions are saying other things, obviously prices, you see them shooting down because there will be total loss of confidence.
Now, you've spoken about policy. Government expects that we should hit single-digit inflation by end of the year, whereas IMF is saying that we can expect an inflation headline of 40%. What is your assessment of where the country is headed? Who's the better prophet here? Is it IMF or that's government?
I think we'd rather be more informed by our own projections against what other bodies might be saying. But IMF is in the right direction. But when you do a simulation of the numbers from a government's perspective to say we might end up between 10 and maybe 20 thereabout, I mean, that is the assumption, the basic assumption will be an inflation figure, a month-on-month inflation figure of just between 0 to 2% thereabout. And definitely that's not where we're heading, because already we've seen ourselves spiking almost close to 5 in the current month, and April is likely to obviously face the same pressures as well. There's been a lot of dynamics. Companies have now asserted themselves to say we are gonna be rating prices, and obviously with the exchange rate going in the adverse direction, then we are likely to see a further growth from that respect. So in terms of who is the right person, the right predictor of events, I want to believe IMF is in the right direction, although our own figure actually even points to a far much higher inflation, and this is mainly based on what we believe are real fundamentals at play. If you are projecting to say we are going to discount, or we are going to subsidize farming to this extent, a rough estimate would give you a figure of just above 500 million in terms of the amount that's going to be committed to subsidization of farming activities. And where is that money coming from? Because already the government, the budget of 2019 does not factor in chipping in, and the net effect is additional funding requirements, which means government has to resort to open market operations, sourcing monies from the routine normal banks, and that's really inflationary as well. And if you are to look at the dynamic around the new currency, which is said to be which they say they want to introduce, right. So this is basically the currency is already there in electronic form, but they now want to get a step further to introduce hard note against that same currency. And I think we discussed it about a few days ago, and we said the impact of introduction of the paper money is a further rise in M1 money. And given that there's M2 and M3, which we might assume that they are stagnant, they're stagnant, as M1 now starts to rise, then definitely the overall money supply is definitely going to go up, depending on the magnitude of injection of the new money. But you can't be introducing new money without having a good quantum or a very good reason to want to obviously play the markets or something like that. So I want to believe all these measures are designed to suit government's needs, and government, I want to believe they really want to stimulate money supply, and all those factors point to further growth in inflation. And in fact, from what Tinashe said, confidence alone is affected by such announcements. We already have got an electronic money functioning against the bond note, And of course, there have been cash shortages, but people were saying, fine, okay, let's see how it plays out. But now you want to introduce a hard copy money against the existing, against the negative perception that is already existing, and that further depresses the generality, and that's going to drive inflation in an adverse direction as well. So I want to believe inflation is going to be worse off. It definitely might close the year upwards of 70, according to our own predictions.
I realize. Now, still in the same vein, we cannot separate economic fundamentals from our gold deliveries. Zimbabwe is actually has gold as its largest forex earner, raking in $1.2 billion in 2018, output 33.2, and this year's target is 40 tons. Well, at the moment, gold deliveries for the first quarter are 11% down from the comparative period in the previous year. What is your comment where that is concerned, Tinashe?
It is actually a slow start to the year, given what was happening in the markets. With current uncertainties, when we came into January and the month of February before the interbank, it means there might be what I may call a speculative holding of gold to preserve value in the wake of these current uncertainties. So if you are actually a producer and you don't know what's happening in your economy, for you to hedge against risk, you go for your safe haven, which is gold. You'd rather hold your gold and maybe deliver when the water is settled. So I just think maybe it's just a slow start to the year. The players were still assessing in terms of government policy, what policy direction is the government considering. Then also in terms, there were so many concerns regarding foreign currency allocations, how much the gold miners will be paid in foreign currency in actual US dollars and so forth. All those are factors that actually affect your actual delivery. I'm not improved with the actual production in terms of out of ground production, what those producers are actually holding, but I really believe there might be some tendency of just speculative holding or just holding to hedge against risks in the economy.
And of course, there have been concerns by the Deputy Minister of Mines that the gold deliveries that we have actually deposited may not be the actual reflection of what it is that we're making in the country. Respect. What is your comment with regards to the figures that we have recorded and perhaps what we could expect moving forward?
2018, we closed the year on a very sad note, a huge dip in terms of Q4 numbers. And the dynamics, it was mainly driven by the issue to do with the retention levels. The retention levels were so low, and in some instances, government was even giving 15% of your net foreign forex earnings. I think one of the players in the market, which is a listed company, Zim, actually said that in one of their statements, and they went on a 2-3 weeks out. They actually to stop production in some of their mines. So those retention levels were definitely a reason why some miners were withholding some of their stocks. And now getting into 2018, we started the year again on a note where production, delivery values were also low. And after the policy pronouncement measures to say we are increasing your retention levels and we are also rating your difference in terms of the market rates, interbank rates, it definitely inspired some to start to now push their volumes back. And the March figure is 2.6 tons, and compared to the same period last year, that's about 2.7 tons March of last year as well. So we are in the right track in terms of recovering the lost levels, but we might not exactly get to prior year levels. I think we will definitely recover. Maybe we'll get into something between 25 and 30, but I don't see ourselves getting to that.
Which would definitely be a concern. I mean, in the just year ended year, we had a trade deficit of $2.5 billion, widening from $1.7 billion recorded in the previous season. And now we've got dipping gold deliveries in the tobacco. Things are very much shaky. We have very low output. Tobacco farmers are actually choosing to withhold some of their tobacco. I mean, what does this speak to in terms of the trajectory that Zimbabwe is going to take in the future? Over to you, Tinashe.
You know, in terms of the overall, the current account balance, or in terms of our trade, gold and tobacco plays a critical role in terms of, you know, boosting our exports. So these slow deliveries and actually the effect of El Nino and, you know, this adverse weather pattern in tobacco, it will actually affect the overall tobacco levels. So I expect, you know, our exports to dip, and also we have also pressures in terms of import because of low harvest in terms of those key food crops. So we have import pressures, high import pressures, and also a dipping exports. So in balance, you will see a worsening trade deficit.
Definitely, that's where we're headed.
And actually also a worsening foreign currency position. So this policy may be by the authorities to try to have a local currency. Maybe they are actually to try to reduce the demand of foreign currency in terms of domestic transactions. So what we are experiencing right now is our foreign currency, mainly the US dollar that we use mostly, is we actually demand it for your domestic transactions as well as your foreign obligations. So there is actually a lot of pressure for the greenback, which means that with the introduction of a local currency, maybe to the positive side, you might see maybe that local currency may be lessening the burden of the foreign currency in terms of domestic transactions. But the risky side is, you look at the current level of reserves. They are so low. They don't support 2 weeks of imports. That's very low. They can't sustain convertibility of a sovereign currency. So, and also a sovereign currency, when you introduce a sovereign currency in the early stages, you should have sufficient reserves to protect it, because in the early stages it will be under pressure, under speculative pressure and under speculative attack from all players in the market. Already we have seen parallel market rates going up. It's actually fear of the introduction of a sovereign currency, and it's the market which is actually already pricing the effect of that introduction of a sovereign currency. So these all things will have an effect to the overall inflation. That's why maybe I wanted to add on inflation, that you see these current levels of inflation. Much of it it's not about your demand and supply fundamentals. Much of it now it's your expectations. It's now being driven by expectations. Most of economic agents, they are expecting inflation to remain high. So inflation will actually tend to go up if you expect it to go up. That's what expectations does.
Yeah, correct.
And the only way to correct or to lower those inflation expectations is to have a history of policy consistency and accountability, as well as transparency. This is a sad thing, especially for government levels, especially government position, especially in these days where we want to see more transparency. I'm actually disappointed by Treasury, because it's not releasing in time key economic indicators, especially those relating to the expenditure side of the budget.
Now, you just mentioned transparency as a measure that needs to be taken in order to dig ourselves out of this quagmire. Back to you, Respect, just before we close. How can we dig ourselves out of this predicament?
I think we're in a very tight spot, but we still have a chance. We still have a chance. I mean, transparency is key, and I'm sure in the other side, be it ease of doing business, there's been a bit of movements in the positive direction. But when it comes to public funds management, there hasn't been as much openness in terms of how funds are allocated. If you look at the monies that our government secured last year from UK and whatnot, there's not been as much disclosure in terms of our loans, even those that are due to some of the African banking institutions, to say what were the terms, what are the interests what are the interests that we're supposed to be paying? I mean, the rates, and whether we have mortgaged our resources or otherwise, and even deals in fuel, whether all those shady traffic deals and whatnot. So obviously, when there's low level of transparency, the populace can only hedge themselves. They can only anticipate the worst, and they can only imagine that there's gonna be doom at the end of the day. So that's a position which government has to correct. But we're at a tough point where there's definitely need to salvage the currency, and sometimes you are forced to even say things that are not truthful just to defend the currency. They had an opportunity to do so during the dollarization era, when you had pegged 1:1. You could create a track record and you gauge where you are in terms of how the market perceives your moves or your management efforts. And then but right now I believe we're in a very tight spot. We're seeing the minister each and every other hour busy updating some basic stuff like Cyclone Idai help, which does not really move much in terms of public sector management. It doesn't speak much to our expenditure and revenue levels. I don't think there's much impact there. So we're in a tight spot. That's what I believe.
Okay, well, that's about it from this particular segment. In the next segment, we'll have a look at the performance of the stock market. Please stay tuned.
Viewers, in this segment we look at daily markets in terms of the stock exchange as well as the interbank, the play in terms of forex. I'm now joined in studio by Anesu Chimbom. Anesu, let's look at what the markets, how the markets played out today.
All right, today was a very positive day today, coming from a snap on Friday where the market was down, but
Sure.
Today it was up 0.25%. much to do with a very strong demand that had values going up about 1,200% to $13 million traded on the stock exchange. The industrials index did add about 0.26% for it to settle at 419.72 points, while top 10 index was the less weightier index that did go up today, coming up 0.11% for it to settle at 119.21.
In essence, we have seen a sustained growth in terms of values on a
Yes,
over the
yes.
past 2 weeks, and
Yes,
I think
yes.
we're now getting into the third week, if not the fourth.
It would be the second. We've just completed the second week, so this would be the third week.
So what does
trend
what does
continues.
this mean? Is there a consolidation of sort? What do you think is driving the market in terms of in the direction of which it has taken now?
Well, prior to the growth in demand, there was a huge outflow in terms of investors going outside of the stock market, going into alternative markets, i.e. your foreign currency market, where there was a little bit of hope and gleam to have thought that there could be better returns and an easier way out of Zimbabweans investment market. So that market seemed to prove them. Otherwise, there has been a decrease in terms, a weakening in terms of the foreign currency exchange rate on the interbank rate. It is now weaker by about 26-27% since its promulgation. So that shows a lot of that shows a lot of lack of confidence in terms of that market. So they have now decided to come back into markets like the stock market, probably taking advantage of counters like Old Mutual, your Citco International Limited, where these are pretty much dually listed. Old Mutual on the JSE, while Citco International Limited is primarily listed on the Botswana Stock Exchange.
I think I copy that, but I also think it's important for us to check in terms of how foreign trades are split. I don't think we have been quite consistent in tracking that aggregate, but I think it would give us a more clearer view of whether the foreigners are the ones who are driving the current research in markets. But I think I concur to say most of the guys who had taken their money off the market to the interbank market have now been frustrated by the long queues, lack of liquidity, and they now feel, how do I preserve my value? Because once you have sold your shares and there's a lot of inflation going on and whatnot, you start to also feel exposed, and you want to come back to the market, and obviously also trying to look for ways of exiting the market through some of those fungible counters. So I think we will need to be tracking that aggregate. I
think I'll be very agreeable with you there, because some of the assumptions do come from some investors having the idea or an assumption that our local demand does not have such power to push up in terms of the values traded on the stock market, not knowing if we then really look into the empirical evidence, how much could we actually turn out.
Local investors account for more than 60% of the current trades in terms of average on a 2018 basis, and it's only earlier in the dollarization period, 2009, 10, 11, when foreigners were dominant in terms of trades. So much of the monies that are being traded on the stock market is mainly local money. That's for 2018. The average is just close to 60% in terms of for local money being in a dominant position. At leading the rise was 20%. Edgar's going up almost the same margin. They released results about a fortnight ago. An improved position, but of course also facing the headwinds in terms of how the economy is performing. Miko's there going up 9.27. Exia 7.46 to close at 36 cents, and Simbisa, which also released results, going up 6.7% to close at 80.25 cents.
On the other end of the yardstick, Hippo Valley did lead up about 5.85% for it to settle at 141.22 cents, while Pro Plastics, who did release their financials in the prior week, did mention that they did enjoy an increased revenue there, but they're also looking at a brighter future as their factory that is now at 97%.
What do you think are the prospects? Do they have the necessary demand to feed into that capacity? Because capacity is gonna more than to actually quadruple. Do you see them having enough demand to feed into that new plant?
I'll suppose that I think they would find themselves focusing more on the foreign markets.
Yes, I agree.
Because local demand may be very much suppressed because of how the economy has been performing. A lot of inflation.
But that's just in the short run, isn't it?
Yes, that will be in the short run. But then on a long run basis, if things then do take a shift in terms of the local economy, there should be some increments in terms of demand thereabout, because I mean they do supply pipes for construction areas, also other markets that they do look into. So with those markets having the scope of them growing because of an improving economy, it could actually give them the space and the depth that they need in terms of the demand that would come in.
Sure, let's move on to FX market. The rate is at 3.16, a gradual upward movement. But I think what the market is really looking at closely has been the parallel market rate,
yes.
which seems to have taken a very sharp turn since last week when the minister announced that we are about to introduce a new currency.
Yes.
What do you think are the dynamics around those? What's your view around this particular market?
Well, this market thrives majorly on the lack of competition it has there from the interbank market.
So are you saying that there's more liquidity on the parallel market than there is on the interbank?
Well, it proves to be at the moment.
I don't think
seems
it's true.
as if so. It seems as if so.
I don't think it's true. The volumes that are moved on the parallel market are
very
very
negligible.
very thin.
Yes.
But then they service an informal market, which is mainly speaks to what Zimbabwe is right now. Informal traders, they want to run to SA to do a bit of taking a bit of orders, I mean, across the region and so forth. And those are people who can't access money through the interbank market.
Yeah.
But I mean, you can't say that volumes of
definitely,
about 2.5 million are being moved in
definitely it would be very, very rude for me to actually mention that the interbank market has no. But then they have not really shown much in terms of data that is supposed to be released for us to actually understand how the interbank market has been playing. I mean, it'll be very interesting, like you did mention last week, that when we do get to see what the trade stats look like, the difference between the import bill and what actually has been traded on the interbank market. Such kind of a difference there, if there is any difference, should tell us how the bigger or more formal businesses are actually working around the lack of foreign currency in the country.
Sure, I think I'm in agreement. We'll wait to see how the market plays out in the coming days. But I foresee the rate also still going up. I think the generality of the market expect the interbank rates to move towards a certain point. Of course, it's not convergence, is what the government is desired to say. The rate should move towards the parallel market rate, because the parallel market rate is clearly running in its own direction. Anyway, thank you, viewers. Stay tuned as we get into the last segment of the show.
Welcome back, viewers, to our last segment. Well, respect, just before we go, the IMF says that it has introduced a staff monitored program in Zimbabwe. Any positives that will come out of there?
I think the gesture is commendable. Just for you to allow someone to monitor your activities according to guidelines that you set together. I think that gesture alone is very is actually commendable on the part of government.
Okay.
If what you were saying in the previous show, to say you should increase your transparency and so forth and so forth. I mean, those are some of the things, and government is committed to allow IMF to monitor its activities around how it manages its finances, and it has to live within certain guidelines. So what they did was to agree on parameters to say if you're let's say you take a certain cost and say this cost has to be a certain percentage of your income. If you exceed, then that means you're not adhering to. I mean, it's a whole lot of aggregates that are included in that. But I think the most interesting thing about this staff monitored program, it's not the first time that Zim is engaging into such. In 2017, we concluded another staff monitored program with the IMF, and the IMF actually endorsed our fiscus management to say Zimbabwe has actually managed to meet all the requirements of the SMP, and that was a worst case scenario. This is a time where money supply was on a very serious run, government running unsustainable deficits, but still we got away with it. So it remains to be seen what really this might mean, whether government will adhere to any such serious measures. But I also believe generally it's not anything to write home about. When you look at our appeal on the international market to say, do international financiers now prefer to extend any such credit A or B or C to Zim? Of course, it's a good gesture in the right direction, but it's not what we are looking for. What we are looking for is capital, but then of course capital won't just follow blindly. It has to follow within certain parameters. So I think it's important for us to look at it and give the new minister a chance to do what he feels is important. But international re-engagement is key, and we should be paying back our debt. And obviously, that's one of the key things that will make us an attractive destination in terms of capital.
Well, thank you, Respect, for the insights. Thank you, viewers, for staying with us. Don't forget to like, subscribe, follow us on Twitter, Facebook, and visit our website www.equityaccess.net. From myself as well as the team, thank you for watching and good evening.